Unit 6, Bonds, Lecture 2, Valuation, Part A. We're going to look in some detail at what a bond and its cash flows look like from the point of view of the investor and the issuer. So we have a bond with a 5-year maturity. Its nominal value is 100 million rand. It has a 8.5% coupon. It has fees of 1.875% and its issue price is 100. So its par is 100. Now the fees, these are usually associated with the primary market, and they are fees that the company pays directly to the underwriters. So it's not a fee that affects the value of the bond. We're now going to look at the cash flows associated with this bond. So we are here today, and what we notice is that looking forward over the next 5 years, we will receive a coupon at the end of each of the next 5 years. So this is an annual coupon bond. Coinciding with the 5th coupon payment at the end of the 5th year, we will also receive the par value of 100 million rand. And we all know, based on what we talked about previously, that the yield to maturity is the discount rate, which will equate the sum of the present values of all the coupon payments and the redemption value to the price of the bond. Now we're going to look at this bond when it is issued first in the primary market, and we're going to look at it from the investor's perspective and from the issuer's perspective. Now the important thing to understand is that in the primary market, the price that the investor will pay will be equal to the par value or the face value. So the price that the investor will pay will be 100 million rand, and this will be exactly the sum of money that the issuer will receive. So looking at from the investor's perspective, over the next 5 years, the investor will receive 8.5% of 100 million rand. So it'll receive 8.5 million rand annual coupon payments, and together with the annual coupon payment for the 5th year, they will receive the 100 million rand that they paid up front. Looking at it from the issuer's perspective, over each of the next 5 years, the issuer will pay 8.5 million rands in coupons, and at the end of the 5th year, together with the 8.5 million rand coupon, the issuer will return the 100 million rand that they borrowed. Now we're going to look at the different factors that can affect various aspects of the bond, and we're going to start with maturity. Now the maturity of the bond is the term that is outstanding, and the feature that can affect the life or maturity of the bond is a call option. Now a call option gives the issuer the right to buy back the bond from the investor under certain conditions and by a specific time. This call feature is usually issued as part of the bond when interest rates are falling. So if a bond is about to be issued and the interest rate environment is a falling environment, in other words, looking to the future, it looks like interest rates are going to fall, then the issuer will most likely attach a call option to this bond, and that gives the issuer the right to redeem this bond earlier. So the 3 call option features that can affect the maturity of a bond can be freely callable. So this allows the issuer to cancel the bond at their discretion, but it comes with a call premium. A bond can be non-callable. The issuer cannot cancel or retire the bond prior to its maturity, or the bond could have a deferred call. So the issuer does have the right to recall the bond, but only after a specific period of time. So it may not be callable for the first 2 years. We're going to look now at the risks that a bond faces. We're going to start with credit or default risk. This is the risk that an issuer or a company will not make interest or principal payments when they fall due. This, by the way, is the only risk that the government is free from. In other words, government bonds are default risk free. because the government can print money. There is interest rate risk. This is the risk that interest rates change significantly from what the investors expect. Then there is prepayment risk or call risk. Now, we've just talked about callable bonds, and bonds are called in a falling interest rate environment. And the risk that the investor faces is that when that bond is recalled, interest rates are falling, so other investments that they can take advantage of will have lower interest rates. Then there is reinvestment risk. This is the risk of having to invest their capital or coupon payments at a time when interest rates are unfavorable, low. We're going to start looking now in some detail at how bonds are valued. And one of the main inputs into the valuation process for a bond is the yield or interest rate. Now, we need a yield to maturity to value a bond, and our yield to maturity is based on the yield on a default-free bond plus an additional risk premium. Now, the yield on a default-free bond is the yield on a treasury bond, because that is the risk-free rate of return. And for the risk premium, we need to take into consideration factors such as credit risk, liquidity risk, call risk, and so on and so forth. And we need to remember, as mentioned previously, the value for bond, in any event, the value of any asset equals the present value of its cash flows. The first valuation model we're going to focus on is the present value model. Now, this model looks at calculating the price of the bond as the present value or discounted value of all of the cash flows that the bond generates, in particular the present value of the coupon payments plus the present value of the redemption payment. Now, the formula you've been given is for a semi-annual bond, but that's not important because it can be adjusted for a bond of any frequency. Now, every model comes with underlying assumptions, so it's extremely important to bear in mind what these assumptions are. This particular model assumes the value calculated indicates what the investor would be willing to pay for this bond to realize a return which is equal to the yield to maturity. The bond is also assumed to be held to maturity. The coupons here are reinvested at the yield to maturity, and the cash flows will include all interest payments, income or coupon, and the payments of the bonds par value at maturity.